Hello and welcome. You tune into News Now with me, Ankita Saxena, and with me is Mansi Dave. And the next half an hour, we'll take you through how the markets shaped up. And as of now, we're breaking with the IIP numbers that is sitting at 4% versus a 4.3% on a month-on-month basis. Mining is at 6% versus a negative 7.2% on a month-on-month basis. We'll keep getting you more details on the IIP. But for now, we are joined by our guest who's joining us now. Hi, Mr. Madan Sabnawis, who's joining us now to weigh in on the IIP number that's just trickled in. Hi, Mr. Madan. Thank you so much for joining us. Mr. Madan is the chief economist of Bank of Baroda, who's joining us. Mr. Madan, the first numbers that have come out, it's coming at 4% versus 4.3% on a month-on-month basis. So it has moderated a bit. What are the factors that perhaps could be weighing in on them? Because as I can see, the 4.3% growth was perhaps the highest since March 2025, marking a rebound that we saw coming in from the weakness from the 3 months before that. Now a bit of a moderation coming in there. What are the factors that could be perhaps weighing the IIP numbers down?
No, actually, if we're looking at IIP, I think what we should look at is how the three major segments have performed. That is mining, manufacturing, and electricity. So my sense is that there could have probably been a bit of a slowdown in manufacturing because when we're looking at things like electricity or even mining for that matter, we had seen a rebound taking place based on the core sector data, which had come out some time back. So I think it's the manufacturing sector which has shown a kind of a slowdown. But still, I think at overall, a number of 4% is very much within what our forecast was. We were looking at a number in the region of 4 to 4.5%. So I think 4% should be definitely comforting. But we should just remember that this particular number is for the month of August. So this is much before the GST reforms did kick in. So any impact of the reforms in terms of overall consumption, which feeds back into production, would be felt only after a month's time or so. So we have to look at this data with a bit of caution. It's a fairly good number, 4% to have, but I think the better things are yet to come if you look at what we're expecting, especially in September, and more definitely from October, November onwards.
Number fairly good as far as the IIP growth is concerned, 4%, as you see, but the manufacturing data is something we are quickly eyeing in. We also have Kanika Pasricha with us, Chief Economic Advisor, Union Bank of India. Kanika, thank you so much for giving your time to ET Now. As you see, the mining data is at 6% versus negative 7.2% on a month-on-month basis. Even Madan was talking about the mining as well as the manufacturing data points which have come in, and also talking about the manufacturing data points which we are witnessing at present. How reliable right now do you see the industrial products data points which have come up, the economic indicative action, and in particular, if we talk about the state of the economy, how do you see this relating to it all?
So first of all, thanks for having me, and I completely agree with Madan sir. He's bang on that while the core sector data had given a 15-month high number of around 6.5%, it's the manufacturing which is showing some downward pressure, which is why IIP is just stuck at close to 4% mark. The only one point to match is that where also I agree with sir, that on mining and even electricity, initially they were in the contraction zone, specifically mining in the contraction zone, because rains were front loaded this year, and that's led to pressure on mining activity itself. But manufacturing is one area which may have come under some downward pressure starting 15th August, because demand for products deferred at least from 15th August till 21st September before GST reform kicked in. So we see we don't see even a September IIP number in being very enthusiastic in terms of the overall momentum pickup. But starting October, when the full-blown festive season impact starts to show up, or even from end September itself, it printed mostly in October in our view, that is likely to show festive season effects and GST reform kicker on IIP, and that can be a slightly more positive number. But from a framework perspective, IIP data's relevance has become very limited. It's mostly what we rely on for manufacturing growth numbers or overall industrial activity numbers in GDP is mostly coming from the corporate earnings releases. And that is very, very important to watch out for as we move into the corporate earnings season starting October. Thanks.
Mr. Madan, I'll take a leaf from what Kanika just said. The corporate earnings, that is something that we're watching out for. In fact, that is the trigger that the market has been waiting and watching out for, for a market to really pick up direction. In that sense, what are you penciling in from the October earnings? Because we do have the tariff hangover as well. And when do you see the earnings really improve because of the tariffs? But then there is also a big macro positive in terms of the GST rate rationalization and the festive season, a boost that's coming in. What are you penciling in as far as the earnings are concerned?
Yeah, let's look at it this way. See, the GST impact is going to be felt from October onwards, so it really won't come in the Q2 results. And what we saw in Q1 was that the growth in the top line was very much subdued. We had growth rates in the region of around 4 to 6% across different industries, with the infrastructure industries doing better than the consumer-oriented industries. On the other hand, we saw that profit growth has been fairly buoyant. So that's one of the reasons why the GDP numbers for Q1 did come out well, because you look at value added, which is profits plus salaries and wages. So there was a good increase out there. Now, coming to Q2, I don't see the picture being anything different from what it was in Q1, at least in terms of top line growth. In fact, there could possibly be a kind of a slowdown, because I think in August itself, there was this indication given that there would be some reforms coming on the GST front. So a lot of consumption could have been deferred from August onwards itself, and something which could possibly show a spike in terms of a revival from October onwards. So I think Q2 would remain fairly subdued when it comes to the consumer goods industries. On the other hand, if you look at what's going to happen to the infrastructure-based industries, that will continue to be fairly buoyant. And I think the same thing will also hold for services. So it'll be more of a continuation of what we saw in Q1 and Q2. So earnings could definitely be something which will be up. But however, the top line growth, which I think is actually a measure of the buoyancy in terms of both consumption and production, is something which we'll have to probably wait for one more quarter before we see any major traction.
Completely agree to that. It's going to be an eventual impact. But Kanika, also talking about the manufacturing and a little more information on manufacturing bit front, I would want, it did show 3.8% growth compared to 6% earlier. Now, is this a deceleration a sign of weakness? What do you think? Or it's just the base effect distortion which you see? And having said so, which industrial segments are currently driving growth and which are lagging behind according to you?
So three key points. See, first and foremost, probably base effects at play, but I would say in case of manufacturing, base effects were just part of the play, because same period last year in August, overall IIP number was negative. So this data was likely supported to some extent by base effects, but despite that, it's stuck in that 3.5–4% range. So nothing enthusiastic despite base effects, which means that the underlying economic momentum, industrial activity momentum, has taken a hit. Now, two more points in terms of winners and losers. Like you were asking, even Madan sir, today when you talk about overall industrial activity momentum, the winners and losers are contingent on the push and pull from one side, tariff hikes, and the other side, the GST reform. And few sectors which are getting under pressure because of this. So the losers are, of course, gems and jewelry, textiles, even auto components, I would say, at least in this number, would be on the losing side, even vehicles, because we had seen marginal pickup in production in auto during the month, but overall the production numbers were subdued. Follow up later in September, likely on GST. So that's one. On the so these were the key losers. On the winning side, I would say it's more of infra-related sectors, like we talk about steel, so capital goods, which are actually doing well, supported by government spending. The other segments which are actually doing still holding up is electronics, because they're still exempt from tariff, though Trump is now talking about some tariffs on chips as well. Even pharma would be holding up in August, in my view, though yet to do a deep dive there. It's only now that concerns on pharma tariffs are coming up. So, of course, winners, losers are there, which are the push and pull forces. But it seems in the month of August, net, it's been downward pressure on manufacturing. Thanks.
Right. Kanika, you mentioned auto sector here and why that has been, an area of interest because the auto sector is the biggest beneficiary of this GST rate rationalization. In fact, the numbers, the dispatch numbers, the booking numbers that we saw coming in 2 days after Navratri and the GST rate rationalization kicking in, those numbers are a record high, sitting at record high. In fact, the auto dealers are very excited about the numbers that they are seeing. Can there be a strong revival coming in the auto sector as a result of that?
Yes, definitely. So, it's also a combination of pent up demand, right? That if you don't have much demand or sales, at least for a month, from production standpoint, maybe they would be doing inventory build up. But it's a rockstar Diwali for auto sector, so to say. So you're absolutely right. A revival likely in auto sector, even in some consumption oriented sectors. Though the volume pickup there in our view will be capped, even in textiles, the volume of production pickup will be capped. It's only premiumization that can come in. But auto, it's the strong pent up demand which will show up in the coming months in IIP, and which is why what Madan sir was also talking about, because of GST, you may see a kicker in the coming months, and auto will be one of the biggest beneficiaries.
All right, Mr. Sabnavis, talking about the electricity sector growth and trends, well, the generation did grew at 4.1% versus 3.7%. Now, does this suggest a structural rise in energy demand or one can say it's just the seasonality factor which is playing here?
Yeah, I would tend to think it's more of a seasonality factor because normally when you're looking at electricity generation, it would be linked with the overall demand. And India does have surplus capacity, so there is not an issue in terms of generation. So normally the way I look at electricity generation, these kind of numbers, is that it will be linked with the overall amount of business activity in the country, which is not just manufacturing, but also in the services sector. So when we are saying it's growth at 4%, this would broadly be in alignment with the overall demand which comes from the economy, the overall business environment. And if I probably juxtapose this with probably also the PMIs which we have of services as well as manufacturing, I think that storyline fits in fairly well. We could be expecting this number to actually increase if you even out the base effects which could be there. But definitely this is something which will move in the positive direction.
Kanika, coming to you, one last question in your closing comments on India's growth outlook. Now, just today, in fact, we had Moody's rating that they have rated India's GDP as stable, and we also see that upgrade by S&P that was long due on India's GDP. Do you see India's growth story intact, especially with the big macro triggers for Indian growth story? But there is also an overhang of tariffs, on the sidelines.
It's like it's all medium term and short term, right? Medium term, of course, our growth story is intact. I would say GST is a path breaking reform. It just sets stage for a variety of reforms where center state consensus was not building up and impeding implementation. Now we have a positive kicker and look forward to more such reforms. So that's one. So medium term, our story is positive. Now, even in the short term, of course, even at 6.5, we are the fastest growing economies in the world. And this year, in the very short term, if I quote the chief economic advisor, he's categorically stated that tariffs over next 12 months may shave off growth by 60 basis points. And this is before the H-1B visa ruling came in, the pharma 100% tariff hike came in. While GST is likely to give a 30 basis points kicker to GDP. So net tariff adjusted for GST softening the blow implies 30 basis points decline in GDP over next 4 quarters. Specifically for FY26 as a full year financial year, we are at 6.7% from 6.5% earlier because of front-loaded growth at 7.8% in Q1, but H1 broad average 7.2, H2 broad average is around 6. So you come to around 6.7% is our view. Thanks.
Kanika and Mr. Sabnavis, thank you so much for joining with us and giving your views on this economic indicative action. So to give a crux, India's latest industrial production data shows moderate growth with sectoral variations as we see August IIP growth at 4%, manufacturing at 3.8%, electricity at 4.1%, and capital goods slowing to 4.4%, while month-on-month numbers suggest some short-term momentum. We also need to take a look at what the overall impact for longer run picture looks like. But on that note, we wrap this segment, but then there's a lot lined up on ET Now, so you stay tuned.